Having a portfolio of robust dividend-paying stocks is one of the best ways to build wealth, generate passive income, and hedge against potential recession, all thanks to the reliable passive income generation. Hi, my name is Louis and welcome to GENF Money. Today we'll be talking about the 8 factors to consider in order to pick the best dividend-paying stocks. Let's get started. First thing first, business fundamentals. Understanding the business fundamental of a potential company that you are about to invest in is crucial because we are talking about dividend paying stocks. We're not looking to day trade or swing trade. We are looking to buy and hold for the long term because we are after a reliable and hopefully increasing passive income generation. Therefore, we need to choose the best company possible. We need to pick the good, solid business with solid foundation. Ask yourself these questions. What does a company do? How do they generate revenue? Are they profitable? How are they managed? How is industry trajectory? Are they able to survive in a recessionary environment? Right? Just learn as much as possible about the business prospect. Now, all this information will help you assess whether a company is something that you believe in, is something that you want to invest in for the long term. Number 2, the PEG ratio. A PEG ratio is a metric that's used to evaluate whether a stock is over or undervalued. It's calculated by dividing the PE ratio by the trailing annual earnings per share growth rate. Let's use Apple stock as an example. Apple stock's current PE ratio is at around 23. And its earnings per share growth rate is at 38% year over year. Therefore, when calculating the PEG ratio of Apple, we use 23, which is PE ratio, divided by 38%, and then times 100 for the calculation purpose. We get a 0.6 PEG ratio. By definition, a PEG ratio that is under 1 is considered an undervalued stock. Anything that's over 1 is considered overvalued, and around 1 is fairly valued. But with the current stock market condition, it's hard to say whether the general investors are still valuing 0.6 PEG ratio as the undervalued stock, especially Apple is one of those high growth, high multiple stocks. So in general, the PEG ratio is still being used to measure whether a stock is under or overvalued. So we might still be able to use it as a general guideline when evaluating a stock. Number 3, dividend yield. Dividend yield is a percentage number calculated by dividing a company's annual dividend payment per share by its current stock price. So a 1% dividend yield, meaning the company is paying back 1% of shareholders' stock holdings as cash reward, is a good metric to measure how much income is generated through your passive income investment. For income investors, usually a 2 to 6% of dividend yield is considered a decent percentage. Having said that, simply having a high percentage of dividend yield does not mean the stock is worth investing, as there are so many other factors to consider. Number 4, dividend payment history. Investors who are looking for consistent, reliable dividend payment should pay more attention to this metric. A dividend payment history essentially is a track record of how companies pay dividend back to the investors. Dividend payment frequency, consistency, and payment growth trend are all good signals to show how reliable a company is as a dividend payer. P&G is usually considered one of the best dividend paying companies out there. If we have a quick look at its payment history, we can see that for a long period of time, there's no payment gap. There's a frequent quarterly payment cadence, and also there's an increasing trend of dividend payment even through the 2020 pandemic period. This is a classic example of a good, consistent dividend payer. Number 5, dividend payout ratio. A dividend payout ratio is a percentage of a company's profit being distributed back to investors as dividends. An 80% of dividend payout ratio means a company pays back 80% of the profit it generates back to the investors as reward and keeps 20%. This is a really good metric to measure how comfortably a company can afford its current dividend payment. If a company has a payment ratio of over 100%, it means it's actually paying out more than it earns, which can be unsustainable in the long run. A comfortable payment ratio should be around 35 to 50% range. Number 6, debt to equity ratio. Debt to equity ratio shows how much a company's debt is in relation to its shareholders' equity. It measures the company's ability to pay off its debts by selling all of its equities during a business downturn. If a company has a high debt to equity ratio, it's usually a danger sign, especially during an economic downturn. So what is a good debt to equity ratio? Well, there's no official definition, but in general, a 2 to 2.5 debt to equity ratio is considered healthy for an organization. Number 7, total return. Total return is a metric that measures the stock's overall performance. It measures the total return rate of a company's stock, including its capital growth, dividends, and interest paid over the past year. Let's take P&G again as an example. For the past year, P&G stock price has grown almost 9%. But if we were to include the dividend paid through the past year, the year-on-year growth became almost 12, which is even more impressive. It's important to assess the overall return of the dividend-paying stock, as the company might be able to keep up with the pace of dividend payouts. The company's stock might decrease significantly during economic downturn, which will mean the overall loss for the shareholder. Number 8, diversification. The dividend stock investors usually look for the consistent, reliable, constant passive income stream. A well-diversified portfolio will be able to protect the investor from any unforeseen risks and keep the passive income stream steady. When building your portfolios, consider including different stocks from different sectors, different industries, or even different markets in order to minimize your risk exposure to any single risk factor. Alright, I hope this video has been helpful. Please do me a favor and click on the like button down below and subscribe to the channel. If you want to learn the 3 things that can help you navigate through a potential recession, I'll leave a video link up there, right there. Alright, I will see you next time. Cheers.